On the agenda tonight, as inflation makes a comeback, burrito prices reach $22 a pop. Is diarrhea about to become more expensive in this economy?
That's gross.
It sure is, Billy.
In mysterious circumstances, the Boeing whistleblower dies. Was it a hit job by the Boeing mafia?
I genuinely don't think there's anything to gain by keeping him around. Get it done.
And Wall Street journalist says he doesn't see a stock market bubble.
It's not easy when you're new in town, except when you have something that makes huge bubbles.
Oh, right. Today is Sunday, March 17th. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. Before we begin, thank you for the kind words from the viewers. I had a health scare recently. I'll keep the story short and sweet, but I'll appreciate the medical experts in the comments. I know some of you are physicians. I also appreciate the bro science. Hey, Maverick, just jerk off twice a day. That'll fix it. That works too. But long story short, about a month ago, I had the same thing happen to me and I woke up face down in the shower and I couldn't move for like an hour. And this last Thursday night, I was also in the shower and I got the same symptoms and I knew what was going to happen next. I didn't want to wake up face down in the shower again, so I decided to sit down. But even with that, I woke up with my wife panicking. What happened? What's going on? And my nose all bleeding because she heard a loud thud. Boom. Next thing you know, she walks in the bathroom and here I am with my nose hitting the side of the tub, all bleeding. What happened? What happened? Then my heart was racing like a maniac. I had difficulty breathing. And then I passed out again, went to sleep. And I had the most vivid dreams. And for a moment, I stopped and I thought, wait a minute, is this really a vivid dream or is it vivid because I'm dead? And that's the new reality, baby. But I woke up in the morning and I had difficulty speaking and moving for a little while. It was a little tough. But by the evening, I was back to myself again. And here's the medical mystery for you, because I heard a lot of things. I heard, heart condition, seizure, an allergic reaction. So folks, have at it in the comments. It begins like this. Your heart begins to race and beat really hard, little by little. Next thing you know, you get a flush, huge flush in your body. It turns all red, itchy, super hot, and that's what leads you to the shower because you're looking for relief. Next thing you know, your mouth is all dehydrated, your face sinks in like the water all sucked out. You look like a 200 years old man. You begin to get blurred visions, your head feels dizzy, and then next thing you know, boom, you're on the floor. And again, no trigger, nothing I ate before, nothing I injected before, nothing I smoked before, nothing at all. It just comes out of the blue. This is the second time it happened. And again, I'm going to seek medical expertise, but why not seek some expertise from the comment section too? But folks, next time if you notice that I'm absent, no videos being produced in this channel, it's either I'm dead, you know, the big man upstairs goes, that's all folks, pulls the plug, or maybe I got assassinated by the Boeing mafia. And that leads us to the juicy topic of tonight's video. And here it is, in focus tonight. Where's the truth, damn it? We're being lied to, propagandized, gaslit. We're being fed like we're crazy if we question the narrative. But folks, maybe we're not crazy. Maybe we're onto something. It's about time we get mad about it. We begin the coverage tonight by the Boeing story. And we talked about it a little bit before in a previous video. We talked about the issues for the company itself. We talked about the issues for the stock, but we never really talked in details about this whistleblower story, which is now blowing up. And folks are raising a lot of questions about this incident, but one step at a time. You know, I love this Drake meme because the government this week decided to ban TikTok. to protect us from information collection by a foreign government, as if they're not collecting our data even more than the foreign government, and for more nefarious reasons, to say the least. But how about doing your job and regulate perhaps one of the duopoly, only two companies in the world, only one in this country, Boeing, that manufactures planes. We all depend on it. Our lives depend on it. In this case, they have to get everything right. And once in a while, you'll make a mistake. That's understandable. But repeated mistakes, one has to question, is it really a mistake or is it just a pattern that is a result of years and years of corruption, where Boeing got away with it for years and years, and now it's impacting our safety. You see, we've been following the problem with the 737 MAX jets after the tragic accident pre the pandemic, and we thought maybe things will change. The regulators will get on it, Boeing will get on it, and they'll fix the problem. We'll be safe again in the skies. And then we realized that nothing tangible really happened in the company Boeing. If anything, things got worse. Quality checks got worse. Integrity got worse in the company. Maybe the wake-up call was the Alaska Airlines incident in Oregon, where the door of the plane just blew off mid-air. But folks, when it rains, it pours. It's a problem after problem after problem, incident after incident after incident. This week, we got the news that American Airlines Boeing 777, carrying 249 people, was forced to make an emergency landing in LA due to possible mechanical problem. Listen to this. This marks the 6th safety incident involving a Boeing aircraft reported in the past 10 days. And this weekend, social media was on fire following the story of a United Airlines flight discovered to be missing an external panel after landing safely in Oregon. It's either Boeing the problem or the state of Oregon. I'd go with Boeing for now. And the reason is we got the audits and the results were disastrous. We talked about this. Boeing quality management was using dish soap hotel key cards for quality checks. Now, I'm a gearhead and I use dish soap to check for leaks, but I'm working in a used car, not a frickin' jetliner with 300 people on it. You'd think they'll use something better than dish soap. Maybe they'll use Flex Seal next time. I don't know about you, but based on my experience, it doesn't really work. Last time I had a leak on my roof and there was a storm coming, I used Flex Seal tape, and next thing you know, I had to call Noah's flood insurance company. So maybe not the best fix for Boeing to follow. But when it rains, it pours, folks. Before that, we got a piece of news that a tire falls off a United Airlines flight immediately after taking off in San Francisco, damaging several cars. And after that, we got a piece of news that United plane flying from Texas to Florida catches fire midair, and the video went viral. Now, I got a beef with the FAA investigating all of this, or even the Department of Transportation. They're all corrupt. It's like hiring the bank robbers to investigate the robbery. It's years of corruption on revolving door policy where we have former FAA employees who joined Boeing and their job is to lobby and meet with the current FAA employees to score favors and turning a blind eye on quality issues. And then when the shit hits the fan, the FAA comes out and says, "Oh, we got to investigate this. We got a problem with this company, Boeing." Whoa. Wait a minute. You're part of the problem, bitch. You should be investigated too. And if there is any outcome that comes out of this, it should be ending the revolving door policy, where we have former Boeing employees join the FAA to corrupt the agency, and vice versa. Former FAA employees join Boeing to lobby on their behalf. And this happens pretty much in every government agency. Look no further than the FDA. You got shoe polish Dr. Gottlieb, who was the FDA commissioner, and after he graduated from the FDA, he joined the board of Pfizer. How can you trust any government agency when you see this revolving door policy? And don't get me started with the EPA, which was at least at some point ruled by Monsanto. And it goes on and on and on. We cannot really ensure the safety of the citizens of this country. And to be frank, everybody in the world flies using Boeing jets. We cannot ensure the safety of people when we have the revolving door policy. But folks, if you thought that was bad, it gets even worse. This week, we also got the news that Boeing whistleblower John Barrett was found dead in the U.S. Apparently, a self-inflicted wound. That's the story that we've been told, but it sounded really suspicious, and the timing obviously added to the suspicion. And then we get the news that the whistleblower said to one of his relatives before he passed, "If anything happens to me, it's not so." That's a quote, which adds to the mystery and the suspicion that maybe there's something else going on here. We're not being told the truth about this story. I'm going to read the details for you and you let me know what you think. This is the exclusive story that we got from the New York Post. The headline reads, "Boeing whistleblower John Barrett made powerful enemies," quote unquote, before his death, as workers are skeptical that he killed himself. Boeing workers warned that whistleblower John Barrett made powerful enemies before his alleged suicide. as a puzzling discrepancy on his police report has emerged. The whistleblower was found dead in his pickup truck in a Charleston, South Carolina hotel parking lot on March 9th. The same morning, he was due to conclude a private testimony in a lawsuit against the jet company where he had worked for most of his career. According to a report by the Charleston police, he had extended his stay at the Holiday Inn until March 8 and was caught in surveillance video leaving the hotel that morning. However, staff at the Holiday Inn told the Post he ate dinner at the hotel's restaurant that night. The police report also noted that Barrett's driver license was still in his room when he was found with a gunshot wound to the head and a pistol in his hand the following morning. Doesn't add up, doesn't it? Just leaves the driver license to whack himself in the car, not in the room. Why? I guess he didn't want to disturb the neighbors, right? The alarm had been raised by Barrett's lawyers when they could not reach him on the phone and requested a welfare check. Employees at the local Boeing plant where Barrett had worked until retiring in 2017 say the whole community is shaken up. One employee who spoke to the Post on the condition of anonymity said workers were skeptical about the cause of Barrett's death, which had been preliminarily labeled as an S word. I'm not going to say too much because the babies on YouTube will demonetize the video. The source adds, "It actually gives me a pit in my stomach because of what he's been saying. And he's dead now. Maybe he offed himself." I'm trying to play with the words so the algos don't go crazy, but you can read it for yourself. I don't know what to believe. We don't really talk about it on the assembly line or on camera from the minute we get on the property. They can hear us, so no one wants to talk about it at work. A lot of people are skeptical because he made some pretty powerful enemies. Another Boeing employee who spoke to the Post said, "Nothing surprises me when it comes to Boeing. It's a good job, but you gotta stay in line. If you don't, you won't work there anymore." Boeing did not directly address the claims, but told the Post in a statement, "We are saddened by Mr. Barrett's passing, and our thoughts are with his family and friends." Oh, really? This is not new to Boeing. They spy on their workers. For years, we heard these reports that Boeing spies on every employee, sometimes not just during work, but even beyond that, and they use national security reasons as a justification. Even the union accused Boeing of spying on the South Carolina employees. Continuing with the story from the New York Post, police have not indicated that Boeing is under investigation or suspected of any foul play. Yeah, I wonder why. I'll talk about that in a second, but just understand this. Boeing owns the entire state of South Carolina. The governor, the judges, the cops, and anybody between. Anyhow, meanwhile, an employee who works at the Holiday Inn where Barrett was found dead in the parking lot told the Post Barrett ate quesadilla, drank a Coke, scrolled on his phone, and seemed fine on the evening of March 8. "I did not think of him at all until I heard the news the next day. He did not seem upset at all," the employee said. Steve Chancellor, who has written 2 books on staged crime scenes and runs Second Look training and forensic consulting, said that when someone dies by the S word, the gun only remains in the person's hand 25% of the time. Uh-oh. The police report also said a white piece of paper that closely resembled a note was found in plain view in the passenger seat, but its contents have not been disclosed. Again, do I trust the cops? Absolutely not. Not these South Carolina ones. When they have relationships to Boeing and probably getting greased by it, you can't trust the governor. You can't trust anybody in South Carolina to investigate Boeing properly. And some of you, by the way, wanted to vote for Nikki Haley, who's owned by Boeing. You understand how grave of a mistake that would have been had she really became president? But I don't know about you. The story just doesn't add up to me. He calls his family as usual. He's texting, he's reading, he's eating dinner. He was talking to his lawyers before. He was scheduled for a hearing. Then all of a sudden just walks to the pickup truck and blows himself out, leaves a note. I don't know about you, but it sounds and it looks too obvious to me, too staged. And hopefully, at some point, we're going to find the truth behind this story. And in the old days, the media was at least trying to find the truth, if not at least raise questions, because it is the job of journalism and the media to challenge the narrative. In the old days, you see a report in 60 minutes, investigating what happened, asking questions. Not anymore. You don't hear about the story at all, except in social media, local news here and there. But it doesn't seem that corporate media in specific want to talk about it. Maybe because Boeing is a a huge sponsor, and we'll leave it at that. But we continue with the question that we began the show with. Where is the truth? At least when it comes to the stock market. And then the economy. We begin with the stock market. Everybody talks about, soft landing, a bull market. There's nothing wrong going on here. You guys are just too negative. Why don't you just embrace the booming economy and the new bull market that we see? This week in the Wall Street Journal, James McIntosh, who I like, he writes good articles once in a while. But this week was pathetic. He says, frothy U.S. stock market just is not crazy enough to be in a bubble. Or really? Why does Mr. McIntosh says that the stock market is not in a bubble? Well, he says, I read the Wall Street Journal. I'm not seeing a lot of pages, a lot of articles mentioning a bubble like we've seen back in the dot-com peak or the subprime mania peak. Therefore, we don't have a bubble. James, first of all, you look at your own chart. The media doesn't catch up to it until after the fact. After the bubble blows, then they talk about a bubble. Number one. Number two, maybe the media today is so corrupted that it is in the business of propaganda, not really doing the news or honest reporting. Maybe this is why we don't hear the talk of a bubble, even though it is obvious to the eye. I mean, even liquid death, which is bottled water, is now valued at $1.4 billion. But again, we'll leave the debate of, whether it's a bubble or not, till maybe after the bubble pops. Then we're going to realize whether it was a bubble or not. But the point being here is that the media is not being objective anymore. The media is being weaponized. And this is why we don't hear any criticism, any questioning of the narrative, any journalism really. It's all propaganda. You look at the Wall Street Journal, same paper. Headline reads, the elusive soft landing is coming into view. Another one, stop fretting about the Federal Reserve's soft landing. Jerome Powell has already reached the runway. GDP and job growth are solid and inflation is down. And by the way, James, dimensions of soft landing? Those are going crazy. Not dimensions of a bubble. We know when they mention soft landing, it usually precedes a crash and a recession. And here are more headlines from your beloved media outlets. CNN says gas prices have surged to 4-month high. Don't panic. It's okay. It's part of the soft landing. Bloomberg says no sign of a bubble forming for Bank of America. This bull market has legs. It has chicken legs maybe. And remember Bank of America analyst Savita Submarine, who used to be one of the most bearish analysts. Then she got embarrassed. She flipped just because, not really because she was convinced. Now says her lofty stock market forecast is more like 1995, not 99. We're not in a bubble. We're just in the beginning of a bubble, I guess. Because, corporate bankruptcies surge in the beginning of a bubble, not at the end of one. Same Bank of America says investors go all in on infallible Fed, dumping cash and buying stocks, implying that money will come out of money market funds and be pumped into equities. And that's the reason for the, quote, bull market. Well, maybe that's misinformation because money market funds, we continue to see inflows into those. Why the hell should I move my money out of money market funds and chase the bubble and the risk in the equities market? You're up 10%, then the next day you're down 20%. There is still an element of brutality in the stock market. And we've seen it this week with stocks like Adobe. Any miss, any problem, and you see stocks going down 10, 15, 20% in a single day. We see the opposite. Any little beat, any little expansion in margins, we see overreactions. Stocks moving by 10, 15, 20% in a single day. And we did the contrast in the latest video for the members between Adobe and Dix. One stock goes down by more than 10% after reporting. The other one goes up by more than 15%. Why would I risk my money in this casino when you got money market funds paying you a decent percentage point with pretty much non-existent risk? No duration risk at least. Business Insider reporting JP Morgan says, what bubble? The Magnificent Seven stocks are actually undervalued. Really? Notice that the media just parrots. Wall Street and the propagandists. No investigation, no real journalism in questioning these statements by JP Morgan. Yahoo Finance. Stock bubble fears are overblown despite Magnificent Seven's rally. Wall Street analysts just report what the analysts say. We obviously have a huge conflict of interest. And by the way, they're not the Magnificent Seven anymore. We lost 2, and soon enough we'll lose 3. Another one from CNBC, at least in this one, they acknowledge it is a bubble. Bubble may be far from bursting. Capital Economics says S&P 500 could hit 6,500 by the end of the year. So we're talking about over a 1,000 points rally in what we have now, 9 months. Market Watch says Run with the bulls. Don't worry about frothy markets until the S&P 500 hits 6,250. Oh wow, that's specific, says Sauce Jen. Folks, you get the point. They quote the analysts from Wall Street, they quote the banks and the funds, who again obviously have a huge conflict of interest. They make their money by keeping you in the market, bubble or no bubble, frothy or no frothy, risk or no risk. Doesn't matter to them. It's all about the commission, motherfucker. They want to keep you in. And if the stock market crashes all of a sudden and you lose your money, oh, it's okay. You know, time in the market is better than timing the market. This is a great buying opportunity right now. You got to give us more of your money. In 10, 20 years, we'll make it all back and then some. What about the retiree who says, I don't have 10 to 20 years? Oh, for the kids. You leave it for your kids. They'll make it back. Oh, you don't have kids? That's okay. It goes to charity. Save the gorillas. Stay in the market. Timing the market is better than timing the market. Do it for the gorillas. And folks, it keeps going. Here's another one for Business Insider. NVIDIA's earnings could mark the start of a roaring 20s for the U.S. economy. Wharton professor Jeremy Siegel, 2024 outlook. Stocks and home prices will jump. Interest rates will tumble. And recession would not hit. Wait a minute here. Economics 101, prices jump. Isn't that inflationary? What is the response to inflation? Higher rates. What is the response to higher rates when they stick for a long time and the economy can't handle it because we have an insane amount of debt? If you said a recession, there you go. And that's the professor. Even Claudia Sam says we're getting there on soft landing data, even though her own indicator says we're heading into a recession, because California's unemployment rate is moving higher. But this is what happens when you have no objectivity and everybody becomes a propagandist for the regime. And this is why folks are seeking another opinion, not from the corporate news world, because you're not going to find any. They go to YouTube, they go to independent media to find an opposite opinion, at least an opinion that questions the narrative. When you hear inflation is gone, we have a soft landing, everything's okay, but you look around you and you're not feeling any of that. You turn on the news, and they keep gaslighting you. You're seeking a refuge in an opposite opinion, an opinion that reflects the reality that you see. But unfortunately, folks, they're also coming for us. And you see the censorship, the bans, and demonetization that hit this channel recently, and many others. And this is why we're awaiting the Supreme Court's decision if the White House went too far in fighting social media misinformation. Because who gets to decide? The White House? YouTube? Who gets to decide what is misinformation? Because the corporate media does misinformation all the time, but they're treated as trusted sources, quote unquote. And all what they have to do is, oh, we made a mistake we didn't know back then, even though their narrative was questioned, and they shut down whoever was questioning the narrative. But folks, we continue in where's the truth? We talked about where's the truth in the Boeing story. Where's the truth in the stock market bubble? Where's the truth when it comes to the story of inflation? Because if you hear the Federal Reserve led by zombie Jerome Powell, he would say we've made a lot of progress in inflation. Inflation is going down and we have a soft landing coming. What about the reality though? That inflation cooled off a little bit, meaning prices rose at a slower pace, but now it's surging higher again. And in some cases rapidly. We talked about the $22 burrito in San Francisco, but it's not just San Francisco, folks. You know what's going around you. When you go to the hair salon, all of a sudden you're paying more than last time you were around. Any service, be it a healthcare service or a car mechanic, plumber, roofer, carpenting, gardening, it costs an arm and a leg these days. And prices keep going higher and higher and higher. You go to the clinic to get some of those fillers in your cheeks to achieve the Ryan Gosling look. All of a sudden, they cost you more than the last time you took them. Good news for Ryan, the cheek inflation is actually transitory. It'll go away, unless the poor bastard took one of those permanent fillers. Then he's toast. Gotta raise rates higher on those cheeks to bring them down. Emma Stone, on the other hand, looks pretty good, right? I haven't met a guy who doesn't like Emma Stone. They just don't exist. Just like honesty in the media, it doesn't exist. But unlike the transitory inflation in Ryan Gosling's cheeks, the inflation in the economy is not transitory. And even Propaganda Minister Janet Yellen came out this week and she said that she regrets calling inflation transitory. Soon enough, Mrs. Yellen will come out and regret calling the economy in a soft landing, but one step at a time. You see, in this channel, we said over and over and over again, you have to get the job done. It is the nature of inflation. When it begins, there's no such thing as transitory. It goes haywire because it becomes a psychological game for reasons that we understand, for reasons that we don't understand. So you have to use the remedy, and the remedy is a recession. And the sooner you get that, the better, because it becomes a mild recession, it erases inflation out of the economy, and then we recover again and rebuild. You don't question how these things work. You don't get cute with it, just like the toilet seat with your woman. You have to put it down, even though it takes her 1 second to push it down, but you don't question it. You just put it down for the ease of mind. And the same thing comes to inflation. When it begins, you have to get the job done. You don't try to say, oh, this time it's going to be transitory, this time it's going to be soft landing. Playing these cute games will end in a disaster. We go back to the Wall Street Journal. Here's the headline. It reads, inflation cooled, but shoppers are sweating $7.99 deodorant. So you're paying $8 for a deodorant. You want to stay clean, sir? That's going to cost you more these days. Stay stinky. And it's not just deodorant, folks. Baby wipes. 2020, the price was $4.25. 2024, the price is $6.64. So it is an inflation rate of more than 50%. Bleach, $2.78 a piece. In 2020, in 24, $4.87 a piece. Cooking oil, milk, deodorant, dog food, eggs, nutrition bars, paper towels, potatoes, even ramen. The college kids, now it's going to cost them more. 62 cents a piece in 2020, $1.08 a piece today, an inflation rate of almost 75%. So it's not in your imagination, it's reality. And they can talk about, oh, wages went higher and all of that, but wages are not really, in reality, keeping up with this kind of insane inflation. I'm not getting 75% raise in my paycheck. You get a raise once a year, and they give you with one hand and they take it with the other, with extra taxation and more inflation. Listen to this. Consumers say they could understand paying more for staples at the height of the pandemic amid supply chain disruptions, worker shortages, and surging demand. But they viewed those price hikes as temporary, says Stephanie Tooley, who studies consumer financial decision-making as a professor at the University of Southern California's Marshall School of Business. Speaking of prices, she said the fact that they're not, meaning not going down, and they're continuing to go up, is frustrating. The Federal Reserve rate-rising campaign has sought to tamp down the pace of price increases, not to lower them. Economy-wide deflation is rare and usually seen as a sign of stagnant or deeply depressed demand. In other words, to fix inflation, you need a recession. You leave inflation going on for too long, you need a depression to fix it. Otherwise, the Fed can say mission accomplished, soft landing is here because the inflation rate slowed down, but the damage to the consumer purchasing power and the quality of life is permanent. Continuing with the article, still what consumers want is a little deflation to lower the level of prices back to where they remember them. Well, we can't do that because we have to take your wages back. Coffee runs are an especially sharp pain point. The smallest available lattes at the chain brands with over 250 locations cost a median of $6.82 in the fourth quarter of 23, according to the food and beverage analytic company Data Essential. That is a 110% jump from the $3.25 a piece they cost in 2019. Tyler Crawford, 31, earned $30,000 pay bump when he switched jobs 3 years ago, and he continued to get raises, more than covering increases in what he pays for food and rent. But listen to this, that does not make him any less annoyed that one of his go-to Starbucks orders, a vanilla bean frappuccino with caramel, is up to nearly $7 from around $5 in 2020. And the whole point of getting a raise is to be able to pay for rent, gas, food, and afford to have some money for saving, for leisure, to go dine out. Your quality of life is supposed to get better. The point is not to get a raise just to keep up with inflation and continue to live paycheck to paycheck. Continuing, at Chipotle, a classic chicken bowl with chips, guacamole, and drink rose to about $20 recently. He remembers paying less than $8 in college when he would go to a restaurant, his feeling at the register when the clerk rang up the total. Shock and anxiety. And oh, by the way, they also ask you for a tip on top of all of that. The airport operation worker who lives in Washington, D.C., says he visits the restaurant less frequently now and orders cheaper items. When he picks up food with colleagues, the prices are a frequent topic of conversation. I don't think people understand that things won't go back the way they were, he says. People will finally get used to it. I'm not sure when. That's the solution, folks. Just get used to it. You'll get used to it at some point. You'll get over it. Right? Until you lose your home because you can't afford to pay the rent anymore. Oh, but rest assured, you'll get used to being homeless. It's okay. And folks, the problem is it's going to get worse. What we see in the economy right now is not soft landing. What we see is what we projected in this channel a long time ago. Stagflation. Inflation comes into the economy. You raise rates. There are two outcomes. You do the job properly, you get a recession. You don't do the job properly, you get stagflation. And then you have to do the job properly under stagflation, which means the economy is a lot weaker than before, and you end up in a severe recession, if not a depression. And we are right now in stagflation. How did we get there? The answer is the cowardly Federal Reserve, led by Zombie Powell, who doesn't want to do the job properly by raising rates until inflation is gone and we have a recession in the economy. Sooner the better, because when you delay it, the severity of the recession gets higher. But Powell doesn't want to do the job because, God forbid, he will upset Wall Street, the banksters, and the oligarchy by crashing the stock market. And Mr. Powell now convinced himself that he can achieve a soft landing. He could reduce inflation, keeps the jobs market hot, keeps the stock and real estate markets in a bubble, and everything will be fine. But now, this week, we'll find out whether Mr. Powell is going to wake up from the fantasy that he's been living in or not, because this week we got important pieces of data. We begin with the inflation side, because stagflation is a combination of inflation and weaker economic activities. Combination of both, stagflation, which is the most devastating economic phenomenon, even more than a recession. This week we got import prices, and the headline reads, import prices rise for a second month in a row and add to U.S. inflation. We got the CPI, consumer prices, and the headline reads, consumer prices rise more than forecast as inflation pressures persist. We got the PPI, the producer price index, and the headline reads, wholesale inflation rose 0.6% in February, much more than expected. How much more? Double the estimate. You can see in the chart here that inflation has bottomed and it's coming back up, whether we look at the PPI month on month or the CPI. There's no doubt about it. All you have to do is just look at the gasoline prices. And you know that inflation will make a comeback. And perhaps the second wave of inflation will be more devastating because the consumer is a lot weaker in the second phase. After about, let's say, 2 to 3 years worth of inflation, what is the response by the consumer? Well, they have to rack up more and more debt to cope with inflation. And now we see households taking on debt faster than before the financial crisis. The aggregate U.S. credit card balance has reached $1.1 trillion. Now, what is the problem with this? You see, the Fed, to combat inflation, raised rates, and rates are still relatively higher. Not high enough to defeat inflation, but high enough to destroy the consumer. And this is why we said in the beginning, Mr. Powell, do the shock and awe, do the Volcker approach to defeat the psychology. And then he can cut rates dramatically after that. It will avert the crisis that we're about to head to right now. But anyways, it's too late for that now. You got $1.1 trillion in debt combined with higher rates. What is the result? Interest payment by U.S. households are surging higher. You can see that non-mortgage is now reaching over $500 billion. That's just interest payments alone for U.S. households. Liabilities for households in the 40 to the 80% share are surging higher. Now the poorer and middle-class Americans hold a larger share of U.S. debt since the pandemic. Folks who are seeing their debt go down, their liabilities plummeting down, are the ones in the 20 to 40%. So it's an economy that works for the rich, not so much for the rest. We see delinquencies on credit card payments because you have high debt combined with higher rates. And you got inflation that continues to go higher. At some point, you're going to fall behind. So we see delinquency rates also moving higher in all income levels. But of course, the poorest Americans are feeling the pain more than the richest. And if we segment the groups to more micro groups than just the 20 to 40%, you can see that most Americans are feeling the pain by incurring more and more debt. The only income group enjoying this economy are in the 99 to 100% income group, the 1%. So again, we're told this is a soft landing, this is a bull market, everything is great, inflation is going down. But if that's the reality, then why do we see folks taking early 401k withdrawals? Due to economic hardship, that rate is jumping higher. And the result of all of this, folks, this week we got the Empire State Manufacturing Survey. And the headline reads, manufacturing activity falls significantly in New York in March. Listen to this. We're not talking about, a drop of 2 points, 3 points. No. New York Fed's Empire State Factory Gauge drops to negative 20.9 from negative 2.4. I don't know how you describe this, but it is a collapse in manufacturing activity. But of course, if you listen to the propagandists in the media and the CNBCs and the likes, every time we get a bad piece of data, they say, oh, it's seasonality, the weather was bad. That's why we see weaker data. And they said the same thing about retail sales in the month of January. This week, we got the updated data about retail sales. Here's the headline. U.S. retail sales miss forecast after a steep drop in the prior month. This is a result of the combination of inflation that's not cooling off and higher rates and higher debt. What do you think this combination will get us to? A soft landing? You really believe that? Even McDonald's is becoming too expensive. McDonald's prices are up, so lower income consumers are eating at home. Folks, if you're living in reality land, not the fantasy world, you know what's going around you. We ask, where is the truth? Be it the Boeing story, or the market story, or the inflation story. But then we're baffled that we're the only one asking questions. The media's not doing it. The politicians live in another world. They no longer represent us. They have other agenda, including insider trading in the stock market, but not the economic well-being of the citizen of this country. And it gets really frustrating. The lack of truth, the lack of objectivity, and the gaslighting on top of that. It gets really frustrating. And the question is, what do we do about it? To be frank, I don't have the answers, but at least we can raise the questions. And maybe, just like the scene in the classic movie Network, a starting step would be saying, I'm mad as hell, and I'm not going to take it anymore. And that's the message of the day. With that, folks, we segue to the market coverage. We begin with the closing of the indices last Friday, and here we go. The diamonds down by 190.89 points, or a loss of 0.49%. The Nasdaq was the leader of the decliners on Friday, down by 155.36 points, or a loss of 0.96%. And the Spider, also in the red, down by 33.39 points, or a loss of 0.65%. While the contrast in the Russell 2000 for small caps, positive by 0.38 points, or a gain of 0.19%. When we look at the sectors on Friday, materials, industrials, energy, financials were positive, be it barely positive, and the laggards once again led by technology, comm services, and cyclicals. We can talk about this as risk on or risk off. So when we see risk on, we see technology, comm services, cyclicals leading the pack. Risk off when they lag. But also a character of risk off, we see sectors such as utilities not only gaining but leading. We're not seeing that, and this has been a theme for a little while. I don't see it as a risk on versus risk off. I see it as the comeback of the inflation theme, where we see metals, we see energy leading the pack, as we see expectations of higher rates also picking up. And that hammers the risk-on sentiment in technology, comm services, and cyclicals. But also higher rates hammer dividend-paying stocks, such as the ones in utilities. When we contrast the daily performance with the weekly, we see that energy at number one by far, which again solidifies that maybe we're seeing an inflation theme coming back into the market. But then we see comm services at number two. What's up with that? I would say the weight of Google rebounding from oversold conditions was the reason why we've seen comm services finishing up at number two. But the majority of the sector was down for the week. I'll show you in a minute. Then we have materials at number three. That's inflationary. Consumer defensive, staples, high dividend paying, but also benefiting from inflation, at least in theory. It has to be tested, of course, because the consumer right now is a lot weaker than 22. Then we see real estate at the bottom, healthcare, technology, utilities. We talked about utilities being down because of higher rate expectations. Technology for the same reason. Real estate for the same reason. Healthcare, I think we have some profit taking in some of the heavyweights in the sector, and that's why it went down. But the all-in-all look for the week, I would say the comeback of the inflation theme. We look at the breadth on Friday. It looks neutral, and this is the objective of the market maker. Believe it or not, the market maker wants to close as neutral as they can during OPEX, which was last Friday. OPEX meaning options expiration. So we see the New York Stock Exchange with 57% advancing versus 41% declining. The Nasdaq, 53% advancing versus 43% declining. We look at the heat map on Friday. We can see that the majority of the selling happened in the big caps, Microsoft, Apple, Google, Meta, Amazon, the technology sector, including software. We got a bad report from Adobe, and that hammered names such as Salesforce, the cybersecurity names, ServiceNow, Intuit all went down in empathy of Adobe. And then we see some dumping in chips, but this time around it was mixed this Friday. I believe this is because of options expiration. So there was a degree of maximum pain where we've seen AMD and Micron closing positive. On the other hand, we've seen names such as Taiwan Semi, AVGO, Broadcom, ARM, ASML closing negative, while the big kahuna Nvidia closing flattish. And if we look at other sectors, we see some de-risking or let's say profit-taking out of healthcare in names like AbbVie, names like Eli Lilly, the Ozempic Mania, NVO. On Friday, a name like Abbott had bad exposure to news from a lawsuit, so it went down by about 3%. But we still see names like Merck and the biotech names, ISRG, a momentum name, doing pretty good on Friday. We see positive activities in industrials, in some of the cyclicals, at least in the automobile manufacturers, some of the banks, some names in energy, specifically refiners, which is my favorite sector for now, but maybe got a little too hot. But on Friday, we've seen names like Philips, Valero, MPC, Marathon doing pretty good. Let's contrast this theme with the weekly theme, and then we see something different. We go back to the inflation theme. If inflation is going higher and you have rates also going to follow and go higher, then valuations come in mind. We cannot really excuse a bubble. We can excuse it under rate cut expectations, not rate hikes. So we see the bubblicious part of the market going down, be it in technology, be it in software and the chips, but Nvidia still holds for the week. That's the most important one. I think folks don't want to sell Nvidia because we have an important conference coming out this week. But again, we see names like Meta being sold, names like Tesla continues to get hammered, high valuations in healthcare also getting hammered. So we see, for example, Eli Lilly down, but we see the value names like Pfizer doing pretty good for the week. Then we have two names that had their own problems, Boeing, of course, and then McDonald's. But the rest of the theme is inflationary, higher rates. What is that going to do to real estate? Not good. So we see real estate down. What is that going to do to utilities? Not good, so we see utilities down. What are higher rates going to do for regional banks? Not good, so they go down. Is inflation good for energy or not? Yes, it is, so we see energy going higher. Is inflation good for metals or not? Yes, it is, so we see gold miners, copper names like FCX doing pretty good for the week. Whether the inflation theme is going to last or not, which, by the way, part of it is the outperformance by staples, at least by a tiny bit. So we see names like Procter & Gamble, General Mills, and STZ, Constellation Brands, doing pretty good for the week. Will this theme continue or not? I think it comes to the hands of the Fed. We have the FOMC coming. If Jerome Powell plays dumb and naive as he usually does, and just delays interest rate cuts, but does not address the problem of resurgence in inflation, then we'll see investors saying, okay, I'm going to go with energy, I'm going to go with the inflation theme. If Powell addresses the resurgence problem, we might see some profit taking from energy, gold miners, all of the inflation theme that went higher this week. Now, bear in mind, if Powell talks aggressively about inflation, then that's not going to be good for technology or the high valuation names either. We might actually see an inclusive sell-off in the market. We'll talk about this and a lot more, but before we do that, let's talk about the heat map for the week for ETFs. Right off the gate, we know that yields went higher on bonds. When we look at the TLT and the TMF going negative for the week, that means bond yields are higher. What is the impact of that? You look at risk-on, yield-sensitive ETFs such as the IYR, real estate, that's down big for the week. If you look at the construction ETF, the ITB, that's also down. The XHB home builders, not down but flattish for the week. The XBI biotech lost about 4.25% of its value this week. The KRE, regional banks, also down about 3.5% for the week. The IWM small caps, risk on, yield sensitive, that's down about 2% for the week. So a lot of folks told me that Maverick, the market doesn't care about the CPI, PPI, that doesn't matter. Well, it does, because yields going higher, it's hammering yield sensitive assets. It's not hammering the defensive yield sensitive theme that much. We're talking about the XLP staples. We're talking about the XLU utilities. I mean, it's down 0.5 percentage point, but not as much as, say, real estate. Then we have the dollar. The dollar went higher for the week in response to the CPI and the PPI. What is the impact of that? We're not seeing much when it comes to the impact of the dollar, because when the dollar goes higher, Chinese equities should go down. On the contrary, the FXI, MCHI were higher. Likewise, when the dollar goes higher, we're supposed to see gold and silver going down. While we've seen GLD down, it tracks the spot price of gold. We've seen GDX gold miners positive for the week. We've seen the SLV silver up big for the week. Then we look at the actual metals ETFs, the XME down, but the XLB higher. What do we extract from all of this? Higher dollar, bad for metals. So we've seen some chemicals, we've seen some steel names going down. Of course, we had the bad news from U.S. Steel because of the Biden administration going against the Nippon acquisition. So we saw the XME going down. But the XLB is more gold and silver. The XLB did better than the XME. What is the message here? Gold and silver are outperforming other metals. Why? I think it's because we have a stagflation theme in the economy. So the impact of a higher dollar is not hammering gold and silver that much anymore. Then when we look at the risk-on technology sector, the majority of the pain came from chips. So we see the SMH down, we see the SOXX down. But the XLK, which tracks the big caps, Microsoft, Apple, Google, Meta, not down by much, only down a little than 1%. So believe it or not, the majority of the weakness in the technology sector came from chips, not the XLK, the big caps. Yet when we look at the charts in a minute, you'll see that the XLK is weaker than the SMH or the chip sector, at least for now. In the last observation, again, energy, the consistent theme, at least for the last couple of weeks, we see the XLE up big, the XOP, which includes gas. Then you have the OIH, the Oil Services ETF, outperforming both the XLE and the XOP, rising by about 4.5% for the week. And I think right now I'm leaning toward the OIH over the XLE because I think the XLE is a little overstretched in the short run. I'll show you why in a minute in the charts analysis, but before we do that, I will show you another piece of data in this next segment, which is commodities. What do we see on Friday's session? It's a mixed session. We see energy flattish on Friday, but natural gas down about 4.5%, so the weaker link remains natural gas. And the problem with natural gas, folks, unlike the WTI crude or Brent crude, it trades in many different markets. And the one we track is the Henry Hub in Louisiana. Usually the thinking goes if we have higher supply, prices go down. Not in natural gas though. If we improve the supply, believe it or not, demand increases. So we see prices on the Henry Hub going higher, and that takes away market share from other indices and other providers like Australia and Qatar. The problem that we have is the Biden administration is freezing LNG projects. So we're not seeing an increase in supply, which will attract more demand. So for now, natural gas is getting hammered. Yet when we look at the dynamics in oil, we know that the U.S. output has reached pretty much all-time highs. We're producing more oil than ever before. Right before an election, one has to wonder why, especially from an administration that promised green energy and death to oil. But now they're producing more oil than ever before. The problem is the increase in oil output comes from fewer rigs. So we're just overworking the existing rigs that we have, even though now the production is taking a dip, maybe a double top, as you can see in the chart. And as production goes down, prices go higher again. But why do I say that the oil services sector is probably more bullish than, let's say, the XLE or the XOP, the big names in oil or gas? At some point, to sustain the increase of output, we need to drill more rigs. Well, for that, you need the oil services to come in. And this is why I think demand will increase for these companies, not decrease. Back to commodities. No stop in sight for cocoa, up yet again about 10% in a single session on Friday. Cocoa prices are exploding higher, outperforming the NASDAQ, outperforming NVIDIA, outperforming AI, outperforming any asset you can look at. And soon enough, you'll feel the pain at the grocery store if you happen to be a chocolate enthusiast. We see cotton, OJ, sugar also moving higher on Friday's session, while we see a modest pullback for coffee futures. On the other hand, lumber down about 1.25%. When it comes to metals, positive again, with decent gains for silver, platinum, palladium, copper. If you pull up a chart of copper, that's doing a saucer bottoming formation, indicating that copper prices will go higher. If you look at the gasoline RBOB chart, it will show you a cup and a handle. It means it's going higher. So when we say that inflation is going higher, folks, we're looking at the charts. Copper going higher, gasoline going higher. What do you think will happen? Inflation will go higher. Now we see gold with a minor pullback on Friday. I think most of it was profit taking. Then we'll look at meats, muted for the session. Lean hogs up about 2% though. Then we have grains mixed across the board. Every time you think that we have a run and we see grains moving higher, they retreat right away. And the problem is the weakness in China. But the winners on Friday were soybean oil up about 2.5%, and then corn futures up about 1%. The loser, soybean meal futures down about 1% for the day. We look at the weekly theme. Here it is again. Cocoa up over 27% for the week. Not the year, not the month. 27% for the week. Soybean oil up over 7.25% for the week. Gasoline RBOB up over 7%. Palladium 6%. Copper 6%. Sugar 4.5%. Brent up almost 4%. So did the WTI. You see what's going on here, folks? This is inflation. It's happening right before your eyes again. Moving on to the big casino, the options market, what do we see here? The volume is up. No surprise here. We have OPEX. So we see the volume up for the most popular names, Tesla, Nvidia, Apple, AMD, and calls outweighing puts. Nothing new here. Usually we see buying of puts after the initial down move already took place. So somebody sells and we see a steep move to the downside, then puts overtake calls. For now, the dynamic remains calls outweighing puts. But I will look at Nvidia. That's the most interesting name for me. If you guys recall, viewers of this channel, back in December, when the IV rank was at 0, I was saying, watch out, Nvidia options really cheap. They can initiate another surge higher in the name. You gotta hold your nose and buy those calls. Next thing you know, Nvidia explodes higher. Now we're reaching 81.5%. Now the call options in Nvidia are absolutely insane. Too expensive for anybody to chase. But we're all waiting before they sell the stock. We're all waiting for the event coming out this week. If the event comes out as a bust with no new surprise, or a new upgrade on the outlook by the company, I think it begins to sell off, and the charts are beginning to show signs of weakness. We'll talk about that in a minute, but we see another phenomenon which is absolutely amazing. Option trades now exceed stocks for the first time since 21, back when we actually had a bubble. $5 trillion worth of option contracts expired this Friday. So it is a casino, and because of the valuations and the prices of these stocks, the AI stocks, the chip stocks, are way too high. Folks are now taking the risk and gambling via options. The majority of these call options of the $5 trillion that expired on Friday were for chips. Do you really think that the negative result that we got for chips this week was a coincidence? Of course not. It was deliberate by the market maker. They see all of you guys buying these calls with the monthly expiration, some of you Johnny-come-latelys buy at the end, chasing these moves, and the market maker says, you really think that's going to be easy? You buy call options and you score right away? Well, watch this. I'm going to drop the price down and make sure that all of your contracts, these call options, expire worthless. And this is why I say to the bears, be a little careful and not too excited when it comes to the drop that we got this week in chips. It could be only due to the market maker activities. We need to see more signs of weakness before you say, okay, the chip sector is going down. We will look at the flows on Friday, the bullish flows for the SPX, MicroStrategy, Carvana, Amazon, Coinbase, Nvidia. The bearish flows for Tesla, Apple, the E-mini futures, Solar Edge. So you have to look at it from a case-to-case basis. For example, Tesla. We see huge contracts here, in the money, out of the money buying puts. And you have to take notice when that happens, that folks see more negativity coming for the name. Sooner or later, rebound or no rebound. Then you look at Apple, for example. Again, they're buying puts, in the money, out of the money, 2.5 million, 17.5 million in a block trade for 25. Most of those are in the money, which means somebody's betting that the name will be down even more than it is right now. Comes 25. You gotta take notice when you see these kind of trades. On the bullish side, we see MicroStrategy. This is a big casino right now, a high roller table. The majority buying of calls, 1,800, 2,000. We see a lot of them. The difference here is they're buying for the week, which means that we have another rug pull operation by the market maker coming really soon in this name. They're not going to reward this kind of behavior for too long. Let's move on to the unusual activities that took place in the options market on Friday. We begin with the ticker SOXL. This is the bullish levered index for the SOXX, the Philadelphia Semiconductor Index. Somebody's betting on a rebound here, so you gotta be careful that we can see a rebound in chips this week because of Nvidia conference, or the drop last week was because of the market maker, and now we have a rebound. So somebody bought the 46 calls for the expiration date, March 22nd. Expectations: the name will go higher and gain more than 7.5% by then. Paid about $1.55 a piece, tenor this trade. All in all, spending about $3 million. Then we have COIN for Coinbase. The crypto mania goes on, and we see huge bets on Coinbase and MicroStrategy, mostly calls, weekly expiration, way overpriced. They're risky, but if Bitcoin surges by 10, 15%, they can pay off. Problem is, what happens if Bitcoin drops by 5, 10, 15%? And these options will go kaput, and you're paying an arm and a leg for them. Take an example for this trade here. 257.5 calls for the expiration date, March 22nd. The expectations, Coinbase will move higher and gain more than 6.25% by then. Paid about $7 a piece, tenor this trade. All in all, spending about over $11 million for 1 week. Lots of risk. Casino mentality. And the market maker, I think, will punish all of this. Then we have the ticker FMX. This is a Mexican company and somebody's betting for upside to come. We see more bullishness coming out in the Mexican ETF. I don't know if that's going to last or not, to be honest with you. But this name is a large component. And somebody bought the 135 calls for the expiration date April 19th. Expectations, the name will move higher and gain more than 5.5% by then. Paid about $2.70 a piece. Dinner. This trade, all in all, spending about $3.5 million. Then we have the ticker FOUR. For 4-shift payment. Somebody sees the name going higher. They bought the 82.5 calls for the expiration date April 19th. Expectations, the name will go higher and gain more than 6.5% by then. Paid about $5 a piece. Dinner. This trade, all in all, spending about $3.5 million. And lastly, at the bottom of the table, what about the ticker MARA, Marathon Digital Holdings? Somebody's buying calls betting on a rebound here. Now, in this channel, we did a really nice trade against the name, and it went down big. We covered the trade this week, at least I did. It was the 25 puts, but we got them when the stock was trading way higher. Now, maybe it is oversold in the daily chart, ready for a rebound, at least according to this trader, who bought the 24 calls for the expiration date May 17th. The expectations, the name will go higher and gain more than 24% by then. Paid about $3 a piece. Dinner. This trade, all in all, spending about $1.8 million. Let's move on to the charts before wrapping it up. We begin with the SPY, the S&P 500, an hourly chart. What do we see here? On one hand, we can argue that the candlestick pattern is of a bear flag. On the other hand, we have to look at the momentum indicators. You see the shifts from bearish to bullish, from bullish to bearish, and they're accurate for the most part. It comes as a confirmation, of course, after the initial move happens. What do we see right now in the MACD? Maybe it is bottoming in the bearish momentum. It's about to curl around and turn into bullish again. And if it does, bear flag or no bear flag, you see the chart moving higher again. So as a trader, you have to continue to watch the momentum in the MACD, the levels, the pattern, everything. But now you know. If we begin to trade Monday, you see the MACD going down even further. You see the loss of, let's say, 508.5. Then you know that we have more downside to come. At least the 506.89. If you see a move higher, say gap higher Monday, you see the momentum in the MACD shifting, maybe curling around, then you know that we're probably going to try at least to close the gap once again at around 511.77. If we pass that number, then we can talk about the highs again. On the daily chart for the SPY, what do we see here? Okay, the RSI is getting weaker. The Vortex indicator is showing a little bit of an increase in the bearish momentum. The last 2 days, we've seen a sell-off and a higher volume. Got it. All bearish signals. But any tangible damage on the chart right now? Not really, because the 20 days moving average has been tested, but not lost yet. If this week we see a loss of the 20 days moving average, then we can talk about an inverse ABC pattern that could take us all the way down to the lower Bollinger Bands at around, let's say, 497.5. That would be the first time, by the way, that the SPY has reached the lower Bollinger Bands since the rally began last October. And it's been a long time, so it's due to happen. But the juiciest trade, folks, happens in the weekly charts. And the one I'm looking for, and I've been waiting for a while now, is when the bullish momentum is exhausted on the SPX weekly chart, and we begin to see the momentum shifting into bearish. For now, we know that this is a steep bullish trend, maybe for a rising wedge, which is a negative, not a positive, because it indicates when it corrects, it's going to be a steep drop. We're not seeing that yet in the indicators. We're seeing that the RSI is elevated. We're seeing the MACD elevated. We're seeing bad-looking candles, doji candles, as a sign of maybe we're running out of gas. If we get a down week this week, you'll see the momentum indicators, the RSI or the MACD, beginning to show us the look they showed us back during the summer of 23, when momentum shifted from bullish to bearish. And that trade was really juicy. We're talking about massive amount of gains happened during that trade alone. And the reason why we see counter trend trades producing more profits is because the volatility is low. But as the turn happens from bullish to bearish, we see the volatility increasing. And that's profitable for options trading. If you're following the trend, which is bullish right now, the problem with that is the volatility is already priced in. The market maker is already pricing in higher prices. So unless you see moves of 2 to 3% per day, you're not going to flip these options for a lot of profits. And at some point, it becomes priced in too much, too expensive to buy calls. Then folks say, okay, I look at the charts, I look at how expensive the calls are. Unless I get a 4% move in the SPX, I'm not going to flip them for profits, so might as well go with the puts. Then the momentum changes. We're getting really close, folks. So keep an eye on this trade. It will be the juiciest trade. When it happens, it could lead us all the way down to the 20 weeks moving average. That would be a drop in the SPX worth about 6% or so. If that target is breached, then we go down to 4,600. That will be a drop of all about, let's say, 10% or so. If that level is breached, then we can talk about the trend line. That will be a drop of about 15% or so. And again, this is a garden variety correction after a steep rally like we got since last October. Even if we go down to the trend line, the trend remains of higher lows, aka bullish. If we lose that line, then we can talk about, okay, now we got a problem. We'll look at the E-mini futures and hourly chart. What do we see here? We talked about the market retesting 5,218. Okay, that was a successful test. The chart moved higher, but then it stalled and it flushed down. And he lost that number. Well, that's a sign of hesitation. That's a sign of weakness. But there were traps in between. For example, forming the bear flag underneath that level, only to move higher. Suck in folks who are going to bet that the mini futures will go higher. Then flush him down all the way to 5,170.25. If you studied the behavior of the chart, you did not fall into the trap, because this level was already retested and then lost. Why would we climb over it again? Doesn't make sense. Now what do we see? We could lose 5,170.25 in an inverse ABC pattern. If we do that, then the chart becomes bearish, because the bear line that we have is 5,170.25. The bull line, 5,218. If we look at the Qs, the Nasdaq, it's the same look. We can argue that this is a bear flag pattern, but then look at the momentum indicator in the MACD. Is it bottoming in the bearish momentum? If that is the case, you'll see a gap higher tomorrow. You'll see at least some dip buying tomorrow. So for now, the chart is not going to tell you where it's going to go tomorrow, but you know what you have to look for. You lose 432.83. Then you know the bear flag is playing out. You know the MACD is extending toward bearish momentum. If you see that, no, we're going above 435. The MACD is now curling around, about to cross, produce green impressions on Instagram. Then you know we're going higher. Look at the Q's daily chart. What do we see here? Volume is increasing on the downside. That's bearish. Our side negative divergence. That's bearish. So is the MACD. The vortex is now showing bearish momentum, about to exceed the bullish for the first time since the beginning of the year. All of these are bearish. And in the case of the Qs, we actually lost the 20 days moving average. So it is more bearish than the SPY. And again, it could be an inverse ABC that leads us all the way down to the lower Bollinger Bands. But before we run with that assumption, we need to investigate where the weakness is coming from the Qs. If you look at the XLK weekly chart, not weak yet. It is still trading almost at the highs. But look at the closing candle. It is bearish. You look at the MACD in the weekly, that's rolling over more than the Qs. So that could be a leading indicator that XLK is going to roll first. Then the Qs will follow. So we see a signal of weakness from the XLK. Not so much though in the chips, the SMH. Sure, we got a topping candle followed by maybe confirmation for now, but the SMH chips is way stronger than the XLK. So for the Qs to roll over, maybe it's going to be led by the XLK, but we need participation by the SMH chips, aka NVIDIA. We need to see that name rolling over before we see real damage in the Qs. You look at the 4 hours chart for the continuous contract in the Nasdaq. Sure, maybe we got a bear flag that's now playing out, but we haven't broken the trend yet, a bullish trend. We see signs of weakness. For example, a repeated head and shoulder pattern that led to pullbacks. Now we have one of those pullbacks, but we never really breached the trend line. If we lose the trend line, warning sign number 1, but we need to see more, losing more support lines, more damage in the SMH, then we can talk. We move on to the IWM, small caps, 4 hours chart. We see the same pattern, head and shoulder. It played out, and now we're toying with the support of 201. We lose that, we got damage, maybe in an inverse ABC pattern, all the way down to 196. We look at the daily chart, we lost the 20 days moving average. It appears that we have negative momentum showing up in the MACD and the vortex indicators, so maybe we have a revisit coming in the IWM all the way down to the lower Bollinger Bands. But bear in mind, the majority of the damage in the IWM came from the drop in the XBI biotech. If that sector rebounds, hard to say that the IWM will go negative. Then we have the Dixie, the dollar. What do we see here? We got the bottoming candle outside of the Bollinger Bands. Then came the CPI, PPI, and the rest is history. You see that now in the MACD indicator, maybe the dollar is turning from bearish to bullish. If it crosses above the 20 days moving average, closes above, most importantly, the 20 days moving average, we have a bearish to bullish confirmation. How would that impact the old man gold? For now, we can say that gold has been really resilient despite the moves higher in the dollar. It remains in a positive look. It is overheated. It is due for a correction. I'm just not sure it's going to be a flush down, but this is going to be the real test for gold. If the dollar makes it above the 20 days moving average, if gold just consolidates, then gold is saying, yeah, I know the dollar is going higher, but we have stagflation. So I'm going to take a break for a little bit, but I'm going higher. Higher dollar or no higher dollar, doesn't matter. If we see a flush down in gold, breaching the 20 days moving average, then okay, it was a transitory run and the dollar ended that run. You look at the gold miners GDX, the daily chart still strong, not showing any sign of weakness. So for now, if we see the dollar going higher and gold not budging, just consolidating, then you probably want to go along the gold miners. Let it cool off a little bit, then you go long. SLV on the other hand, silver, I'm not sure. It appears that we have a reversal, topping candle, awaiting confirmation of course. So I favor gold over silver in this case. Then we'll look at oil, UK oil Brent. What do we see here? The bull flag is playing out. We see the momentum indicators are now improving toward the bullish side. So you look at the XLE, this is the energy ETF from the weekly chart. It is positive, momentum is increasing, but maybe a little too hot. It's trading outside of the Bollinger Bands. Maybe it needs to consolidate a little bit to allow the bands to expand and meet it. Then you look at VLO, the refiners. It's the same look. Really hot, all-time highs, outside of the bands, maybe a little too hot. We see the same look in CRAK crack, the refiners ETF. Breakout of the bullish flag, outside of the bands, still bullish, but maybe a little too hot. Then you look at SLB, a component of the OIH, the oil services ETF, and the most important one. We talked about this look of a falling wedge. We added to our position in SLB. Then we got the breakout above the falling wedge, above the breakdown candle, above the 20 weeks moving average. That's a bullish move in SLB. And unlike the XLE or ExxonMobil or even Valero and the refiners, this one is not really crazy. It might be a catch-up play, and it has more room before it becomes overbought. Then we'll look at the 10-year yield daily chart. What do we see here? Breakout of the falling wedge above the 20 days moving average. Look at the MACD now changing to bullish. Vortex indicator is giving us a confirmation. The most alarming chart, though. On the weekly chart, we see that we have a crossing and a closing above the 20 weeks moving average. You see the RSI, the Vortex, the MACD, all given confirmation that yields are now positive. We know that the algos will be really sensitive. If we go to 4.5 and the 10, to me, that's going to be the threshold where we see the algos dumping stocks like mad. If we go to 4.5, we're probably going to challenge the highs again. And the story about soft landing and cutting rates goes down the toilet. Then we have yield-sensitive assets such as the XHB, home builders, daily chart. What do we see here? The MACD is turning negative. Okay, that's a good sign. For a swing trade, perhaps. Maybe we have a double top, but we need to see a little more damage. I would say losing the trend line and the 20 days moving average would be a start. We see more weakness in the IYR though, the real estate sector. We spotted the topping head and shoulder pattern in the hourly chart. We took a trade on it on March 13th. Then we saw the IYR flushing down. The trade is still good, even though the hourly is becoming a little oversold. Maybe a rebound is coming. But then you look at the daily chart, and you see that the MACD in the daily chart has turned negative, and we closed below the 20 days moving average 2 weeks in a row. And the suggestion here is rebound or no rebound, we're heading down. And we have the lower Bollinger Bands as target number 1, then in blue, the 200 days moving average. You look at the KRE regional banks, the hourly chart. In the last video, we talked about maybe we have a falling wedge and we see a breakout. We got that on Friday. Now we can argue that this is a bull flag pattern. KRE regional banks will head higher. So we need to see a loss of 47.5 before we assume more downside to come in regional banks. The VIX Volatility Index hourly chart, what do we see here? Perhaps a pattern of higher highs and higher lows, which is bullish. Then you look at the weekly chart, we closed above the 20 weeks moving average for the first time since last year, which suggests to me that the VIX will move higher. And the first real correction in this rally that began last October will be underway. We look at the Big Kahuna Apple daily chart. What do we see here? Consolidation for now. Not the time to short it though. We need to see a loss and a close below 172. And the reason is you look at the MACD indicator, it appears that the bearish momentum is bottoming. And we're now shifting to bullish. Doesn't mean that Apple has to rally. If it rallies, then so be it. But if it consolidates for now, it means that we have more downside to come. It just needs to cool off a little bit. Either way, it doesn't make the best short. It makes a good rebound trade, but we need to see a little more. I'm afraid that this could be just consolidation for now, just to allow the bearish momentum to cool off a little bit before we go down again. So there is nothing for me to do here in Apple. We got a juicy trade to the downside. We achieved the target. We're done with it. You look at the weekly chart. We got the inverse ABC pattern or the lower Bollinger Bands. That's support for now. You got to wait and see. Tesla, the souffle, on the other hand, hourly chart. What do we see here? The chart peaked above 180, peaked below 175, then decided to go with the lower destination. And it lost 175 once and for all. That was a shorting signal. Okay, now we're at 163-ish. We see the chart at least attempting to form these falling wedge patterns, failing to produce a pop, of course, but it's a sign that we have buyers beginning to show up, that maybe we have oversold conditions. Whether these buyers are legitimate buyers or just short covering, who knows? What we know is we have maybe a saucer bottoming formation. So there will be an attempt here for an oversold rebound. You look at the daily chart, we're oversold at the lower Bollinger Bands, and that supports at least an attempt for an oversold rebound. The problem with the name though, if you look at the weekly chart, we have a bear flag that's already playing out. We have support at around 152.37. Maybe we get there when we find support. But boy, the RSI, the MACD, they have plenty of room before they become oversold in the weekly chart. So we can go down to 110, my next support. That will be in or around the low from 2022. That will be erasing the entirety of the pop in Tesla. So you got to be really careful with this name. You need a really good hedging strategy. Then we look at NVIDIA, an hourly chart. What do we see here? Maybe we're seeing some bearishness showing up, a little bit of weakness, a little bit of stalling, a little bit of exhaustion. Name it what you want. Doesn't matter. But we don't have a loss of 860. We don't have a loss of 824 to assume for sure that we have more downside to come. Now, in the daily chart, you can see that the momentum in the MACD turned bearish. It was a good sign that the stock is going down. Then came the report to the rescue. Now we're doing the same look again. Can we escape this one by the conference? Maybe. I doubt it though. I think the conference would be confirmation that maybe NVIDIA has peaked. And if that is the case, then maybe we're in for an inverse ABC pattern that would take us all the way down to the 20 days moving average. Then we'll look at AMD weekly chart. We have a topping candle with a confirmation this week. If it is indeed what we're looking at right now, then AMD should be heading down to the 20 weeks moving average. That'd be a loss of about 19% of its value from this point on. Could happen really fast. I mean, this is a really high beta and volatile stock. But this is a weekly chart, so you also have to keep that in mind. It's going to take time for it to work out. Unless if we have an overall sell-off, then it could happen rapidly. What about tulips? Bitcoin, what do we see here in the daily chart? We got one sell-off by the whale, and the buyers showed up again, forming this rising wedge. Then the bear showed up, and we broke the rising wedge. The momentum was too hot. It is now under process of correcting. Is it enough of a correction that we went down from, let's say, 73,000 to 65,000? Maybe not much. But for now, we have buyers showing up. There is aggregate demand showing up. I would look at the action, though, as weak. And the fear is if we have another whale saying, okay, I gave it a shot, they allow Bitcoin to go above 75,000. Now we have OPEX coming at around March 29. Then we have the halving event coming next month. Who knows what that's going to do to the price of Bitcoin. Maybe you should be taking profits right now. If that happens, we could see a correction all the way down to 58,325, and I would think at that point it would be at least an appropriate correction of the move that we've seen so far. If we look at Coinbase, the proxies got a rebound on Friday, but the weakness is still here. And if we see Bitcoin dropping down, let's say another 5-10%, you'll see a sharp correction in Coinbase too. So we have a bearish trade on this name. I want to stick with that trade for a little while. And then what about Mara? Daily chart, the miner. Talked about the topping head and shoulder. We took the shot, it flushed down. Maybe it is oversold right now. It reached the lower Bollinger Bands. Tried a rebound, couldn't make it. This is the second attempt. We see maybe a sign of success. We look at the weekly chart. It averted disaster because the MACD is going to turn bearish sooner than later. The RSI is bearish. The vortex is about to give us a bearish confirmation, but we haven't closed below the 20 weeks moving average. Maybe we catch a rebound on the hourly or the daily charts. But at the end of the day, the weekly chart will play out. We might see the Maverick top. We flush down in the miners, and the halving event will be a bad outcome for them anyways. Lower Bitcoin prices will be a cherry on top. A poisonous one, of course. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? We have plenty. On Monday, tomorrow, we have the Home Builders Confidence Index. Tuesday, March 19th, we have housing starts and building permits. Most important day comes Wednesday, March 20th. We have the FOMC and the conference by Chairman Powell. And of course, among the question of interest rates and what is his take the resurgence of inflation, we're also looking at what is the Fed going to do about the emergency funding facility for regional banks. It was supposed to expire this month. Will the Fed extend the facility or end it as proposed? What will be the impact on regional banks? Then Thursday, the 21st, we have initial jobless claims on top of the Philly Fed Manufacturing Survey. That comes on top of the services and manufacturing PMIs, along with U.S. leading economic indicator, and concluding with existing home sales. Friday, the 22nd, we have nothing at all, so we might take the day off. Anyhow, folks, we have reached the conclusion of this video. If you found it helpful, informative, entertaining, please help us out by pressing the like button, subscribe, leave us a nice comment, and consider joining us as a member to access the daily videos and many more, either on YouTube or better yet, join us on Patreon so you don't have to pay the big guy. You can find the link in the description. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
I don't know what to do about the depression and the inflation and the Russians and the crime in the street. All I know is that first, you've got to get mad. You've got to say, I'm a human being. God damn it. My life has value.